Hello, welcome to Traders Workshop. This is episode 1 of season 2 of the podcast, and I am your host, Adam Grimes. You can find more of my work on my blog at adamhgrimes.com. You should follow me on Twitter at adamhgrimes, and you should also check out my work at marketlife.com. So this is a new season of the podcast, and I want to talk a little bit about what is happening in current markets. This is the middle of March 2020. So if you're no doubt, if you're listening to this somewhere down the road, you know that I'm speaking from the middle of a historic period in financial markets. We're going to talk about that. We're going to talk about what's going on, how to navigate. But I want to start just by telling you where I've been, because it's been a while since we've had a podcast. And in that time, I've been very busy. And the reason you've had no podcast is not because I am lazy, but because we have a lot of irons in the fire around here. And one of the things we've been doing a lot of work on, a lot of quant, a lot of statistical modeling, and we're using this for some very exciting models that we're doing, which so far are having most of an impact on some of the longer term and macro work we're doing. But over the past couple of years, I've been more and more focused on that. Now, for those of you who don't know me, I'm a trader. I'm a discretionary trader. But I'm a bit of an unusual discretionary trader because I also do a lot of statistical work. And I feel that at least my path to being my best trading self is that my discretionary decisions have to be wrapped in some statistical quantitative sense. So to that end, I do a lot of research, a lot of modeling. We've been doing a lot of that. We've also been doing a lot of applied trading. And this, my trading partner, Tom, and I, this is something that has really just been a game changer for me because, to be perfectly honest, over the last 10 years, I would say that my mindset has become more and more institutional. Now, what I mean by that is two things. First of all, it means a focus on somebody who has a large account and a lot of resources for putting a lot of different things at work. But it also means a mindset that is above all defensive. So first of all, you're focusing on preservation of capital. And I think one of the underlying principles of trading is that that's a little bit of a balancing act between getting aggressive outsized returns and preservation of capital. So you can go out and you can try to make a lot of money, or you can be pretty sure, and I hope you hear the quotes around sure, you can be pretty sure that you're not going to lose the money you have. Those two things are a little bit incompatible. And for most people, there's some spot where there's some mix of those two things, which is what we want to do. But over the past 10 years or so, my trading's become more and more focused on capital preservation. And what we've realized is that that doesn't work for everybody. And it has made, I think, I'm always criticizing what I'm doing and looking for things I could do better, for things that I'm missing. And I think one of the things, frankly, I've missed over the past many, many years is that there are a lot of people with smaller accounts who could have, with the right guidance and the right framework, could have very good and financially significant results with those smaller accounts. Now, there's higher risk, of course, and that's also appropriate. But Tom and I have been, in addition to doing a lot of thinking and research and thinking, talking, planning, we've actually been doing some practical trading in a small account that we hope to be able to, so far the results are, I won't talk about the results, but they're extremely positive. They've exceeded all of my expectations, and what you're experiencing here is me being giddy, excited about something. We are excited, but it's going to be something that's going to be appropriate for somebody that has a $5,000 account or maybe even smaller. And I think a lot of the things out there, one of the reasons that I've been a little bit resistant to that, frankly, I think a lot of people who would sell you a program for a small account, it's some kind of scam. My personal feeling is it's some kind of scam or it's somehow dishonest. I think there's a lot of crappy, half-true marketing, if even half-true. So we didn't want any part of that. We wanted to do something that's very real and legitimate and true to our principles. And we're not quite there yet. We need some more time with it. Unfortunately, and we'll talk about this in a moment, a lot of this trading has lined up with a period of extreme market stress. And that puts us in a situation where we've done very well, but somebody might reasonably ask the question, and it realistically, we've straddled the more normal market conditions to where we are now. We've traded in both and done well in both, but I'm always a little concerned when I see somebody bring me trading results that come out of a period of exceptional volatility, because I don't know, can you do that on any average day of the week? Well, we think we can, but that we need to prove that. And another thing that we've been spending a lot of time on, trading options very actively, and I am utterly and completely convinced that so much of what is sold to the public with options trading is very wrong-headed. And this, what I mean by this is this emphasis on being net short options, and the idea that most options expire worthless, therefore you should never buy options, you should always sell options, and that's the only way or the best way to trade options. I've thought for years that's not true, and I'm still becoming more and more certain that that's not true, especially as we experience in our own trading in this small model account. Over and over again, we see that we're taking directional exposure and also getting paid for time. So this idea that an option is a decaying asset, therefore you should sell it, well, what you really should do is spread it. So we'll talk a lot more about that. You'll see a lot more about that. I've also been very focused on, and this is not a bad thing, but certainly over the last 10 years, if you go back to this old podcast, I talked a lot about macro work. And for many, many years, I was struggling to get a macro process where I felt I had my hands around all of the data. There's a tremendous amount of macro data. Nobody knows everything. Nobody touches everything. Nobody understands everything. It's just, it's outside of the ability of any person or even any institution. There's just so much stuff out there. But I wanted to have what I thought would provide as comprehensive a picture as possible, and to also have something that was based in quantitative truth, but spoke in a very practical way. What I mean by that, for instance, the employment numbers, and it's funny to be talking about macro because we're certainly in an environment here on March 16th, 2020, where nothing matters less than macro numbers. Market's all emotion and fire and human behavior, but it won't always be like that. It certainly is not always like that. But if you think about an economic series like Jobless numbers, and you will see that journalists report every time there's some little change in the jobless number. Well, you have to think about what's the normal variation of that series. Just kind of a basic thing, right? Like how much does a thing bounce around on average, so I know if this current move I see is something significant. So we've done a lot of work like that, and when I say that, it doesn't sound particularly interesting, profound, or useful. But trust me, it's all of the above, because we're doing this with I don't even know offhand 60, 70 economic series, and what it's done is allowed us to build a very comprehensive forecasting model. The other piece of that, of course, is that, and the folly of this kind of modeling, is that what truly leads is price action in the market. That's why everybody likes to make jokes that economists can't predict the market, and there are all of these very mean-spirited jokes about how stupid the discipline is. And that's not true. The discipline is not stupid. It's certainly limited. Every discipline is. But the reason that forecasts fails so frequently is because you're using the wrong thing. The market is the leading indicator. And if you're using economic numbers to predict the market, you kind of have it backwards. So in addition to having this powerful macro process, we put it in the correct context of the action of the market. And, again, we don't like to brag, but we got this current turn. We've been consistently bullish, and we caught the current turn, I think, as soon as anybody possibly could have. This process is, even as we're speaking today, proving itself. So we're very, very pleased with that. And then on a personal note, I'll talk more about this in the future, but I've been writing a lot of music. Some of you know that before I was a trader and while I was learning to trade, and there was significant overlap, I was also a classical musician, and I've returned to that with quite a degree of focus and intensity. So I'm producing some music, and that obviously eats up a lot of time. So that's where I've been. So the podcast, one thing I think you noticed, if you know the old podcast, this is, I always try to keep the podcast casual. I'm trying to keep it even more casual. We're not going to put an intro and outro on it and do this big produced thing. I want to make this more and more just like you and I are having is it a conversation if it's one side? Well, this is kind of what it's like to talk to me. Like, I never stop talking. So if we were having a conversation, it would basically be like listening to a podcast. At least that's what I imagine a lot of people experience talking to me. So, I want to make this very accessible, very, immediate, I guess would be the way to think about it. So we're not doing intros and outros. It's going to be a little bit less produced. I also want to, and this is a little bit difficult right now because there are so many important current events to talk about, but I want to continue to focus on principles and ideas and things that you can apply 10, 20 years down the road, rather than talk about what's going to happen next month, because that's maybe interesting now, but it's not so useful. Also, this is everything that we talk about is going to be, even the quantitative stuff is going to be in context of what you do with it as a discretionary trader, because you still have to make a decision, right? You still have to make a decision when to pull the trigger, when to get in and out of trades. And even if you hand a good chunk of that decision process over to an algorithm, which, by the way, is not a bad idea for a lot of people, you still, you would play a part in that decision process. And then the last thing is, and this is something I wrote about on my blog. I'm struggling because I don't really quite know how to articulate some of the ideas. But over the last maybe 3 or 4 years, I found myself drawn to the importance of spirituality, not just in trading, but in our human experience. And, I guess this may just be something that happens to people as they get a little bit older. You start to kind of think about, like, what's all of this mean? Why am I doing all of this? And how does it all fit together? And I think that there's kind of a weird, backward thing here with trading, that if you get a lot of that alignment right, it's also good for your trading. So you make more money in some ways. It's not really the goal, but it's coherent. It's coherent, and it all holds together. And I have a lot of these ideas which I'm kind of grasping at. I just don't know how to put together. So it's something that, and I'm also a little bit uncomfortable talking about, just to be perfectly frank, but I think is a very, very important thing. And it's something that I'm going to really force myself out of my comfort zone. I said I would do it. I haven't done it yet. I've been, it's something that maybe this is the format for it. So where are we today? Well, what we're looking at here is a market that is moving in the space of minutes. I'm not exaggerating. In the space of minutes, we're seeing markets make moves that would normally have taken a year. And certainly you'll see markets move in minutes, what would normally take in a week or a month. But we're seeing many days where, for instance, today the S&P was down over 10%. Well, an average year in stocks over a long period of time is about 7.5%. So this market lost more than an average year in a day. And this is not the first day that's happened. The volatility has just absolutely exploded. But a few thoughts on this. One of the things that is true in market environments like this is that emotions really drive. Emotions drive the market. That's what I meant when I said earlier that we've never been in a time when macro and like actual numbers matter less. They do still matter. The core of what is driving the market action is some rational assessment of, hey, this coronavirus is having an impact on the world market and world markets, and this is going to be bad for a lot of economies. It's going to be bad for a lot of companies. Therefore, things probably aren't worth what we think they are today. Therefore, things should be sold. And the market automatically does that. That is a natural function of the market. But then what happens is traders become emotional. And, when I say traders become emotional, probably the first thing you think about might be a new trader, right? A new trader with a small account sitting there looking at his Robinhood screen, chewing on his fingers, like not sure what to do. That's your idea of an emotional trader, right? Yes, but no. The emotional trader is also the institutional money manager with billions of dollars at his disposal. You would be surprised, I think, how emotional some of these people are. And as much as we would like to think that decisions are made at all levels on rational analysis, anytime a human makes a decision, this is one of the things that I've come to believe very firmly over the past two decades. Any human decision includes a combination of emotion and reason. Both of those things are there in varying degrees. If you're about to get in a fight with somebody, you're probably not planning that rationally. On the other hand, if you're thinking about buying something expensive and you're doing the budgeting, you're probably thinking more rationally, but it's always a mix of reason and emotion. And what happens when the market becomes volatile is that the emotions start to drive more than the rational analysis. And that's a big part of what we're seeing. We're seeing very emotional markets. The thing that is interesting, but honestly, not the slightest bit surprising to me is if I see it a million times in my life, I think it's still going to be interesting. What's interesting is that the tools that we use continue to work through the market volatility. So the markets are more volatile, things are swinging. Guess what? Same tools work. And that's kind of an exciting thing, right? And this is not to say that trading these markets is easy. It's not. You need to take some common sense precautions, like probably setting stops that are, this is not a probably, but setting stops that respect the volatility. When the average true range of a market increases from 17 to 110, then you probably can't still use your 4-point stop, right? Things have changed. Your stop has to adjust. Your position size should probably also adjust. So you're trading relatively smaller positions. You probably want to be a little bit more selective with your trade selection. You want to make sure that you're not looking for trades. You want to make sure that you take trades, that you're not forcing trades, that you take trades that only really fit very exactly your trading criteria. These are the kinds of things that it's enhanced common sense, I guess is the way I think about it. None of this is profound. None of it's particularly surprising, but the same tools, the same patterns work. You just have to make some adaptations to your behavior. And basically, I'm going to say something that's a little bit clumsy and crude here, but when the market gets emotional like this, the market gets stupid. The market will make moves that are stupid. Then those moves are stupid. The market will overreact in both directions. The market will have all kinds of weird fake outs. A lot of market participants will get stupid. And of course, I'm grossly overcharacterizing, but you can't. That's the point. The market can be stupid. The market will be stupid, but you can't. And this is why you have to develop the sense of managing and being aware of your emotions and making sure that they don't play too much of a part in your decision-making process, but knowing they are always going to be a part. So that's kind of where we are today. I just wanted to reconnect with you, the listener, basically, get us thinking a little bit about what's going on in the market. I'll try to drip some podcasts out here pretty quickly. And I have some interesting topics, like one of these things that I've been talking about a lot. We're now running a trade room a few days a week at marketlife.com. And one of the things that we were talking about a week or so ago was this idea of market time, and that market time is not linear. That, I certainly have felt sometimes over the past couple weeks that by the end of the trading day, that I've lived an entire week in that trading day, and I feel, beaten up, even though you might make money or you might even not have a position on, but just still living through these market gyrations. One reason that we perceive that things are so different is because the experience of market time is not clock time. It's very closely tied in with volatility, and there's some both quantitative and practical lessons here. So we'll talk about market time. I'll talk about risk, psychology. A lot of as always, I'll try to do some Q&A. And one of the other things that you can expect is we're going to reissue the old podcast. The Market Life podcast is no longer available, but I get lots of requests that tend to kind of center around the same few episodes that people want to see. So we'll reissue some of those in this new podcast series. And if you haven't heard those, then I hope they'll be interesting. And if you have heard them, maybe hearing them again will bring you something new. So let's wrap up there today. Go check out my work at marketlife.com. You should be reading my blog, Adam H. Grimes. But mostly, I really think you should follow me on Twitter at Adam H. Grimes. That's kind of my central hub where, this podcast will go out on Twitter. It'll just let you know everything we're doing. And I will see you back very soon for another podcast. Thank you very much.